Hey everyone, welcome back to Corporate Decoder. Today, CDT Equity Inc. just filed its quarterly report, and I am seeing a huge warning sign about their ability to keep running. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is in serious trouble with cash, and it looks like they know it too. So this is CDT Equity Inc.'s quarterly report. A Form 10Q basically telling us how the company did financially in the first 3 months of 2026. Let's dive right into the numbers. On their balance sheet, which is like a snapshot of what the company owns and owes, we see some really concerning figures. As of the 31st of March 2026, their cash and cash equivalents, meaning the money they have readily available, was just $97,000. Compare that to December of 2025 when they had over $1.5 million. That is a massive drop. Now, they list an equity method investment of over $122 million. This sounds huge, but it is an investment in another company, Sarborg, where they only have significant influence, not control. So it is not cash they can just grab and use. On the flip side, their short-term debts or current liabilities are over $21 million. This includes things like accounts payable, meaning they owe money to suppliers, and their total stockholders' equity is a deficit of over $7 million. That means if they sold everything they owned, they still would not have enough to pay off all their debts. This is a major red flag for the health of the company. Now let's look at their operations, how much money they made or lost. For the first 3 months of 2026, they reported a net loss of over $4 million. That is on top of a loss of almost $4.8 million in the same period last year. They are consistently losing a lot of money. And look at these shares outstanding in 2026. They had over 730,000 shares compared to just over 1,200 in 2025. This massive increase is likely due to stock issuances, which can dilute existing shareholders. This is where it gets really serious. It shows how cash is moving in and out of the company. For the 3 months ended the 31st of March 2026, they used almost $1.9 million in cash just to run their day-to-day operations. And in 2025, it was even worse at nearly $4 million. They are burning through cash just to stay afloat. Their total cash dropped by over $1.4 million in this quarter, bringing their total cash to that tiny $97,000 figure we saw earlier. This is the big one. In the notes to their financial statements, they talk about liquidity and going concern. This section is crucial because it directly addresses whether the company can survive for the next year. Listen to this, management itself states they do not have enough cash to fund their plan. They explicitly say this raises substantial doubt about the company's ability to continue as a going concern. This is a direct warning that they might not make it for another 12 months. This is like a company saying, we might go bankrupt. They expect to keep losing money and using cash, and they will need more funding from their stock sales program. But they admit there is no guarantee they will get that money. If they do not get it, they would have to cut back operations. This is a very risky situation. Let's look at some of the details in the notes. On the 19th of February 2026, they invested $123 million in Sarborg. Remember that Sarborg investment we saw on the balance sheet? This is how it happened. They gave shares and warrants in exchange for this investment. They have these convertible notes payable, which are basically loans that can be turned into stock. Valuing these is tricky and they use complex models. The fair value of these notes as of the 31st of March 2026 was over $773,000. Looking at their fair value measurements, we see that their convertible notes payable are valued using level 3 inputs. This means the valuation relies on unobservable inputs and requires significant judgment. This adds a layer of uncertainty to their reported values. There is a significant legal battle mentioned regarding a judgment against a former subsidiary, Conduit Pharmaceuticals Limited. Even though they sold that subsidiary, they are still on the hook for approximately $9.6 million, which is reflected as a liability. They are vigorously defending their position. But this is a substantial financial risk looming over them. They have a stock incentive plan, but as of the 31st of March 2026, there were only about 5,800 shares available for issuance. This is a very small number for a public company, especially considering their low stock price. And the report flags that their disclosure controls and procedures were not effective. They mention material weaknesses that have not yet been fixed. This means there are problems with how they report information, which is another serious concern for investors. Overall, this company is burning through cash at an alarming rate. They have very little actual cash on hand, significant debts, and are consistently losing money. The fact that management themselves admits there is a substantial doubt about their ability to continue as a going concern is the biggest red flag here. Looking at the comparisons, research and development expenses are down 15%, which could mean they are cutting back on developing new products. General and administrative expenses, however, are up 7%, showing that the costs of running the company are actually increasing. They say they believe they can raise more money through debt and selling stock. But history shows that companies in this kind of financial distress often struggle to secure that funding, or if they do, it comes at a terrible cost to existing shareholders through heavy dilution. It is like a gambler hoping for a big win to get out of debt, and not realizing the odds are stacked against them. They also did a massive one for 25 reverse stock split back in March 2026. This is often a move companies make to try and boost their stock price, but historically about half of microcap companies that do this end up delisted. Think about Radio Shack before it went under. They did a similar pattern for a $1,000 investment in a company doing this. It is not uncommon to see the value drop by another 40% or more in the following months as the underlying financial problems remain. What I am actually looking for is if they can secure new funding without completely destroying shareholder value. Alright, that is my take. Stay decoded if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.